Bitcoin's biggest swings often begin in silence, not on the headlines. $10 million in order walls, sudden taker bursts, and structure breaks flash warnings hours before the news arrives. Missing these hidden signals means trading blind, while others see the move coming. But why do these patterns repeat? And how can you spot what most traders ignore? A liquidity zone forms when clusters of large resting orders, often $10 million or more, appear on the order book, creating invisible magnets that attract price action. These zones show up as dense bands on heat maps, mapping where major players are willing to transact. When order book depth thins around these levels, it signals vulnerability, and the path of least resistance draws price toward the wall, setting up rapid sweeps or sudden reversals. Prop traders track these zones in real time, watching as price probes, absorbs, or rejects at these boundaries. The presence of a $10 million wall does not just anchor price, it flags a level where hidden intent and potential volatility converge, often well before any headline explains the move. A break of structure occurs when Bitcoin's price decisively clears a previous high or low, disrupting the established pattern of higher highs or higher lows. These moments are not random. They represent a shift in the market's topology, often surfacing 6 to 12 hours before volatility accelerates or before headlines emerge. Analysts validate a break of structure by confirming that price closes beyond the prior range boundary, rather than merely wicking through. This structural break acts as a medium lead warning. It signals that institutional flows are repositioning before the broader market reacts. In back-tested samples, structure break events led to significant price expansions within that 6 to 12-hour window, offering a measurable edge for those focused on market structure rather than narrative explanations. A sudden burst of taker activity, when aggressive buyers or sellers sweep the order book at more than twice the recent baseline, often acts as the immediate trigger for sharp moves. This imbalance cuts through resting liquidity, forcing price to gap toward the next available depth. Yet not every sweep leads to expansion. The probability rises when volatility has compressed, measured by the average true range falling at least 30% below its 90-day median. In these conditions, even a single prop trader executing a decisive sweep can tip the balance, transforming latent structure into real movement. Still, compression alone is not a guarantee. It sets the stage, and order flow decides the outcome. On March 12, 2020, Bitcoin's price collapsed by more than 50% in less than 24 hours. The headlines would later blame the COVID-19 panic, but the real warning signs flashed long before the news cycle caught up. Open interest on major derivatives, exchanges like Deribit and Binance, climbed 15% from one day to the next, a clear sign that leverage was building across the system. Funding rates flipped sharply negative, hitting minus 0.06%, as perpetual swap traders paid a premium to stay short. At the same time, exchange inflows spiked. Large holders sent coins onto platforms, quietly preparing for liquidation. A risk desk manager at a leading exchange tracked these metrics in real time. As open interest ballooned and funding rates slid, the imbalance became impossible to ignore. When price began to slip, forced liquidations triggered a cascade, draining liquidity and sending Bitcoin into freefall. By the time mainstream headlines caught up, the move was already in the rearview mirror. The data told the story hours ahead of the news. On a Tuesday in June 2022, over 2,000 Bitcoin, worth more than $40 million at the time, moved from a single anonymous wallet onto a major exchange. Blockchain trackers flagged the transfer, but no headlines followed. Within minutes, order book depth thinned as market makers pulled bids, exposing a gap just below the current price. Sellers stepped in, and the order book's fragile support evaporated. Over the next 2 hours, Bitcoin dropped 15%, slicing through resting bids as automated trading systems raced to adjust. On-chain data from Glassnode later confirmed the inflow, but the move itself unfolded in silence. No rumors, no breaking news, only a sudden vacuum in liquidity. By the time social media speculated about insolvency or forced selling, the damage was already done. This was not a cascade triggered by derivatives or leverage. It was a flow-driven move, set off by a single actor who never appeared in the narrative, leaving only a trace on the blockchain and a void on the chart. Every data point in this analysis comes from public, verifiable sources. Order book snapshots are pulled via API feeds from major spot and derivatives exchanges, including Binance, Coinbase, Deribit, Bybit, and OKX. On-chain flows are tracked using Glassnode and CryptoQuant, which aggregate blockchain data to monitor wallet transfers and exchange inflows. Each of the 20 major pre-news price moves referenced here is sampled across multiple venues to minimize bias. No single exchange or data provider dominates the sample. Aggregation methods align timestamps to UTC and cross-reference price, order flow, and derivatives metrics, ensuring consistency. This approach provides a transparent foundation for interpreting signals, allowing for objective review and replication by any technically skilled observer. Compression and order flow signals offer a measurable edge, but they do not guarantee outcomes. In backtests, 35% of volatility compression phases fail to produce significant moves. Spoofing, when large orders appear briefly to mislead, remains common, especially around key liquidity zones. Internal transfers can also distort on-chain data. These limitations remind traders that no single indicator is infallible. Today, algorithms track every order book shift in real time, while headlines still lag. In markets wired for speed, the edge belongs to those who read the signals, not the stories. Stay sharp.